Well, we talked a little bit about index rebalancing, and we'll talk a little bit more about that. But when that happens, what tools do traders have available to them to minimize their price impact when they're trading securities?
Yeah, so one I mentioned is the algorithmic wheels, working with our TCA teams, but also tools that we deploy a lot is limit on close orders. So we might be benchmarked to the closing print that day, but we're not just going to necessarily blindly put a market order out there and get filled at whatever that closes. We're going to put limits on those orders, so we're not going to have impact above a certain dollar amount. But again, I think when I talked earlier that we do take risks in the portfolio, this is exactly where we could take some potential risk in a trading strategy, with the motivation to not have unnecessary impact on a security. And that may look like, again, trading a little bit early. It might look like limit on close orders on the bell, and then potentially having some residual that you need to trade in the next couple of trading sessions afterwards. But yeah, it's something we definitely take very serious, and we do not want to be the print in the market that looks terrible, because ultimately that is not a good outcome for our shareholders.
And how has the growth of indexing made that more challenging? It's pretty difficult now to, not maybe move the market when you're talking about funds that may have hundreds of billions of dollars under management and are making enormous trades. Has that become more challenging as the funds have grown?
I actually think it's less challenging today than it was in the past. And even though indexes has grown significantly, so has the awareness of indexing and funds that follow. So what we tend to see is active managers, hedge funds, other participants using index rebalances, index changing as a moment for extreme liquidity. So we might see a lot of times that certain names, we're getting caught up from an active shop saying, hey, are you guys going to be out there in this name? So you see that as well. And then I also think the evolution of rebalancing and the awareness of it has actually provided significant more liquidity and actually smoothed out impact from indexing over time. And what I mean by that is, let's say 20 years ago, we were the only ones that were rebalancing. Nobody was aware of it. We would have to buy certain names, and we're benchmarked to that day's close. So you'd potentially start buying earlier in the day, start having impact, but to get done, you need to kind of coerce sellers to sell. What happens? Price goes up, you get filled. The next day, price comes down, and that all happened in a one-day period. Then what you saw is actually banks, when they were able to take more risk, they were getting and pre-positioning in these index changes maybe 3 weeks before. So you saw that gradual increase in these security prices become less. And now what you're seeing in the market is other players are getting into those trades sometimes months in advance. They're predicting what the index is going to do. So you see an even more smooth amount of impact, because that trading that happened in one day is now happening over 3 days. And you don't see the impact that directly from indexes as much anymore at all.
That sounds like we had Marco Salmon on this podcast a while ago, and he talked about his paper, The Disappearing Index Effect, which basically documents that. So it sounds like you just explained kind of from a practical on-the-ground perspective why that's been happening.
Yeah, you beat me to it, Ben. I was going to mention the paper.
Yeah. I guess one of the places that you may see the biggest impact is when individual companies are included or excluded from an index. So that kind of reconstitution that happens from time to time. How is a company's stock price affected when it is added or deleted from an index?
A couple of ways that I think, at least on the research side, we think about this is, maybe going back to Andy's point where everything was kind of you're in the S&P or you're not in the S&P type of world. And I think, again, nowadays, this idea that index providers have what I might call like a full family. You have the U.S. total market. Typically, if a stock is entering one subcomponent index, it's exiting another.
Right.
Meaning, stocks migrating up to the S&P 500, they're leaving the 400, or if they're being removed from the 500, they're being added to the 400. And you have this effect now of it's two-way buying and selling. One stock being sold from one index means you now have buyers on the other side. And that's not just index funds making those trades. Going back to the premise of Gus Sauter, and indexes should reflect the way that active managers actually act. They're faced with these decisions based upon the strategies that they run, what in their world qualifies as large versus mid versus small. And Gus was pretty clear about that. In the real world, an active manager doesn't have this hard line in the sand where he and she says, oh, the stock is below $1 billion, it's out. Like I'm cutting it. They have what index providers call buffer zones as well. But either way, these migrations of stocks across subcomponents of indexes, it's not just a day in the life of index funds migrating those stocks. It's a day in the life of active managers making those decisions. How do they migrate stocks, whether it's across the cap size continuum or the growth value continuum?
That's like an obvious, that now that you've said it, but not something I thought about before. That's a really, really interesting point. That's also part of Marco's paper, I think, right? The index to index migration is one of the reasons, because there are now so many indexes and index funds. That's one of the reasons we've seen that decreasing index recomposition effect. Just on other impacts of the growth of index funds, we've seen research from Valentin Haddad suggesting, he was also on this podcast a while ago, suggesting that index funds have decreased the price elasticity of stocks. Is that something that you guys track or measure or think about?
I'll say my group doesn't track that explicitly, but in many ways, when these phenomena come up, I have a different area of research that I cover, and it's the concept of a stock's return dispersion. And maybe I'll start it off by saying for both of you, if you thought about the Russell 3000 index, and my team and I have looked at this since about 1990, and I said, on average, what do you think the number of stock or the percentage of stocks in the Russell 3000 in a calendar year that either outperform the index's return by 10 percentage points or more, or lag the index's return by 10 percentage points or more? Just water cooler trivia for you both. Like, what's the percentage of stocks?
It's going to be a big proportion lagging, I think. Smaller proportion with more outperformance. That's like the that JP Morgan study that looks at these data, I think.
So if I said it's pretty consistent, it's about 70% of the stocks either do better than 10 percentage points off the index or worse than 10 percentage points off. And the way that we see that is when we think about what active management is all about. Active management is about identifying and being overweight the stocks that outperform, and it's identifying and being underweight the stocks that subsequently underperform. And when we think about this growth of indexing over the course of the past 25 years, and then I think about, well, what's the dispersion of stock returns have been? It seems like there's ample opportunity for active management to take advantage of stocks that are both outperformers and underperformers.
If you look at the REIT index, which is one of the highest indexed sectors out there, if you look at the top performing 10 names, they're probably up over 32%. The bottom 10 names are down over 25%. So I think there's a lot of room out there for active managers to find the value in these indices.
So you guys are saying that like dispersion has been pretty constant since the 1990s?
Correct.
Huh. Yeah, okay,
Sounds like it's a stock picker's market.
Always and never.
That's
how do you think that high index fund ownership share affects the behavior of stock prices? Like we just talked about dispersion there, but like are stock prices getting more volatile? Are they getting more sensitive to flows?
For me, one of the most interesting, and I wish I had the visual here, is research we've done on what does proportion of ownership look like in the U.S. stock market. And I know that when I show this chart, most are flabbergasted when they see it, and maybe I'll do my best to describe it here. Is imagine, I'm showing you a dot plot where the x-axis is simply Russell 3000 stocks. It's number 1, 2, 3, all the way to number 3000. And then your y-axis is simply plotting for that given stock, what's the proportion of its shares that are owned by something that is legally and technically called an index fund. In a If all investors were truly passive, it would be a flat horizontal line, because in a market cap weighted indexing world, all stocks have the same proportion of its shares owned. But that's not what we see. We get this Bode effect where as you start small and approach mid, there are increasing proportions of ownership. And then that level crests, and it actually starts to fall as you move towards the large cap space, which meaning this idea of index funds only own the largest and somehow make the largest larger, turns out the greatest amount of ownership is more in the mid cap space.
Whoa. Yeah, that's interesting.
You know, I always think more from a practitioner's perspective, but around 18 billion shares trade on any given day, about $750 billion notional. Index is probably somewhere around 1 to 3% any given day. So the vast majority of trading that happens in any exchange on any day is active. So there is definitely price discovery that is happening in real time each and every day that has nothing to necessarily do with index or index holdings.
There's price discovery. The thing that I don't know if you guys are aware of Mike Green. He hammers on these ideas a lot. We had him on this podcast a while ago, and the thing that he convinced me of a little bit is that it's not necessarily price discovery that's the issue. It's that prices are getting more sensitive to flows because of decreasing price elasticity with increasing indexing, and that's the concern more so than a more traditional measure of market efficiency. I don't know if you guys think about that.
It's interesting. I was just recently listening to the podcast Vanguard versus DFA, and part of the commentary that was going on about it was this, if I'm articulating the discussion correctly, was this preference for investors to be picking risk factors rather than picking individual stocks. And it resonated with me because I go back to my early days at Vanguard working specifically in our ETF product management group. And working with financial advisors, what we maybe now take for granted, way back in 2008, 9, 10, advisors were building their portfolios, their active portfolios, but all the pieces in the portfolio were index ETFs, like traditional market cap weighted index ETFs. And it was clearly evident to me that, whether we want to call that price discovery or not, if Andy's a DFA'er and he's heavily tilted towards small cap value, and Jim doesn't like that at all, I'm heavily tilted in my portfolio to large cap growth, even though our portfolios might be both nothing but index funds. That's relative valuation in action. We're both imposing our views of what we think the market will both give us in our portfolios and using index funds. To me, that's still the very nature of relative valuation and even price discovery. If he prefers small in value and I prefer large in growth, we're an active market.
Anecdotal, but I would point to some events like Silicon Valley Bank when that happened. Within 2 days, that stock had fallen 97%, and there wasn't a market for it. It didn't matter who was holding it. That was pretty much gone. So I think real events, real news, real active positions still drive prices.
So we've kind of been talking about this idea of, price discovery and how are index funds affecting prices. And this question really comes from our episode with Mike Green. His concern is, as I mentioned, decreasing price elasticity, which is causing prices to go up. And I know we already addressed this a little bit, but I'm gonna ask it anyway. Causing prices to go up now, and that in some future state where index funds start having outflows because of the decreased price elasticity, there would be big price declines as money left index funds to something else. Do you guys think about that scenario, and does it concern you at all?
I'll tell you what, Andy. I'll start off with two things.
I'm super interested to hear both of you, but like Andy's perspective on, actually executing these trades. Yeah. Anyway, carry on.
And maybe my views are a little tilted. Of course, I'm more in the research space, and Andy's actually he's on the desk. And the first thing I think of is somewhere embedded in that thought process is that somehow only index fund investors sell and active fund investors don't sell. which we kind of know the opposite to be true. That the propensity for index fund or shareholders in index funds to trade and transact is less than the propensity of those in active. So I always maybe challenge the notion a little bit that, first of all, index funds are not an asset class, and history demonstrates that even the assumption that only index funds would sell kind of seems a little far-fetched. But then the second part I think about is, to me, those concerns are rooted in, the active manager community. I don't know if it's a fear factor or what their incentives are, but again, active management is a relative game, not a nominal game. So good active management doesn't necessarily care if prices are going up or down. It's given they're going up or down, can I do better and add relative value? Like, that's the nature of active management. I don't know, Andy, if you have anything on top of that.
What's an outflow? No, just kidding. The vast majority of my career here at Vanguard, we've definitely seen a lot of inflows into the portfolios. One thing I can speak on is our clients tend to be very resilient. So even during, whether it was COVID or the GFC, we saw a lot of inflows. I don't know if we saw a significant amount of outflows that were coming out of our funds in droves. To me, it would have to be some type of bigger, broader economic scare that would probably be the catalyst behind that. And you'd hope there'd be somebody that would be out there buying. But if nobody's buying and everybody's selling, then yeah, you're going to have a crash in the market. And we saw a couple of those in the last 15 years. 44% down in a year and a half in the GFC. Some significant outflows. But ultimately, I think clients are resilient around the world. They see buying opportunities, and I don't necessarily think it's going to be index holders that are the catalyst behind those type of moves.
Now, you guys have touched on this already in a couple of ways. We've talked about index funds and their so-called label of being passive, but how passive is the way investors are actually using these funds? Jim, you'd mentioned that portfolio managers, for example, might use passive funds as building blocks in an active portfolio. Presumably, retail investors at the individual level are often doing the same thing. And are you able to measure that at all? Do you know how your end investors are using your funds, or is that not something you have any visibility to?
Well, it's tricky because, again, if I thought about what's maybe something most don't know about Vanguard, is our biggest business is the one that serves financial advisors. Yeah, I know Vanguard's origins come from a direct retail investor, but in terms of the business that's the biggest, and I referenced before where I got my start in Vanguard, is the one that serves third-party financial advisors. And it was there I got that first experience of seeing just the firsthand, wow, they're great. They're using Vanguard index ETFs, but that's clearly an active portfolio that they're building. And you get a real good sense of trends in the financial advisor community and the way that they think about active management. And as you guys have discussed before, wanting to build portfolios on the basis of risk factors, not explicitly stock picking. And it's influenced my research career, even with I think it's a 2022 article in the Journal of Beta Investment Strategies, how investors use passive for active. I mean, I've been seeing this for the better part of 15 years.
Can you talk about that paper and how you guys measured the fact that index funds are being used actively? Because that was a pretty cool research idea.
Yeah, thanks. Maybe the simple way to do it is say we take a look at U.S. equity funds, and it's pretty easy in Morningstar to start out with kind of, again, the binary categorization, something that's legally and technically an index fund, and then if it's not, it's an active fund. And we build 3 portfolios. From the index fund category, we try to identify funds that are strategically, again, it's the characteristic of the fund, a total market index fund. And whether it was a Russell or a CRSP or a S&P total market, but funds whose objective it is to track the total U.S. stock market. And then from that same sample of index funds, once we've carved away total market index funds, we're left with the other group, which we call non-total market index funds. And yes, to answer maybe some, I know the question's probably popping into some people's head, the S&P 500 is a non-total market index fund. And we have an asset-weighted portfolio of total market index funds, an asset-weighted portfolio of non-total market index funds, and we have a portfolio of active funds. And what our hypothesis was to say, hey, if you look at the performance, the monthly performance of the asset-weighted portfolio, as expected, the portfolio of total market index funds tracks the total market index. I think we picked Dow Jones total stock just by default as a kind of a third-party neutral index. And the dots sit right on zero in terms of what their excess return is. And we would all say, well, that's what's expected. Probably in retrospect, maybe I should have not put the labels on the portfolios in the research paper and just showed the two lines of active funds and non-total market index funds. And, you see them kind of moving around, plus or minus over the course of that time period. And you'd look at them and say, well, both of them look like active experiences. I really don't know which one for sure is made up of what we would call conventional active funds and which one is made up of non-total market index funds. But the aggregate asset-weighted experiences, they both have this active experience of, bumping up and down, plus or minus around zero.
Oh, it's really interesting. So it's like the total asset weighted portfolio of non-total market index funds behaves like a portfolio of active funds, which suggests that investors are using those non-total market index funds in an active way.
And it's maybe ironic, it's a little bit bizarre, but I know you've talked about Sharpe and the arithmetic of active management. In that paper, we break our sample down into two time periods. There's a pre-2009 and a post-2009. And we do that because somewhere in 2009 is the point in time where if you were to look at the community of non-total market index fund assets, prior to 2009, the S&P 500 index fund assets were more than 50% of that group. And then post-2009, S&P 500 index fund assets are less than 50%. But when we then said in both those time sets, just simply what's the mean monthly return of all three of those portfolios? And I don't know the exact numbers, but they're basically all equal. Like as if we view funds as a proxy for the total market, they're obviously not all assets in the market. But using it as a proxy, as Sharpe predicted, gross of expense ratios, the mean monthly return of the those three asset-weighted portfolios, they're pretty much sitting on top of one another. The difference is the tracking over the course of time.
Yeah, that's interesting. We hear about the share of index funds owning such a large portion of the stock market and how that's been increasing, and that's one of the things people worry about, like we were talking about earlier. How does the market share of total market index funds compare to that of non-total market index funds?
The shorter answer is it's far less.
Far less in total market?
And if we went back to assets, you would find that total market index funds have far less in total assets vis-a-vis assets in non-total market index funds. And to me, that's one of those critical discussion points, whether it's academic research or just the discussion in media headlines or in the practitioner industry is, oh, it's passive or active. And my thought is there are hundreds, if not thousands, if not tens of thousands of index funds around the world. And even if we then break them down into sort of their subcategories of strategies and objectives, and then we add in there's probably different index providers within the same strategic space, you realize that the world is going to passive. It's really not anything about that. These are, dare I say, they're tools for active management. But I wouldn't want anyone to think that's a bad thing. When we all have unique preferences in our personal lives that dictate, well, what's the type of portfolio that I want to set up, and done well, using these different strategies is a benefit to all of us. I mean, generally speaking, they're providing great diversification benefits at low cost. There's still the responsibility of how you put them together in a portfolio. But when we take a step out and we realize that, yeah, most of what investors are using and how they're building it, they're not quote unquote being passive by just simply owning the total market.
Andy, I think it was you that mentioned earlier that at one point you had transitioned from MSCI to FTSE indexes for one or more of your groups of funds. How frequently do the underlying indexes change for your funds, and what goes into that process? What would encourage you to switch from one index provider to another?
Yeah, it's happened a couple of times during my career. I've been at Vanguard 23 years, and I think I've seen it maybe a handful of times. It could be methodology, it could be fees, it could be preference from shareholders, but it's a number of different factors that probably weigh in on it. Probably fees being one of the best and one of the biggest. We want to make sure we're not overpaying and making sure our clients have the best chance for success.